Good afternoon and welcome to the Way to Wow, People Making Money. I am your host, Kevin Bemmel, and we are here every Wednesday, 12:30 p.m. Pacific Time, 3:30 p.m. Eastern Time, an hour in for Central and Mountain Time. Hopefully I'm doing that right from your perspective. And we talk about how to gain greater professional success, start a business, and build wealth. And last week, if you happen to catch the show, we talked about retirement accounts. And this week, I'm going to talk about fundamentals of investing. So after years of working or starting and running a business, hopefully we've been able to retain some of the money that we've made and build wealth that will allow us to enhance our lives, even if we decide to retire or maybe just to slow down in terms of our work. All personal decisions that each of us has to make. Some of us, probably won't ever be able to stop working, even if we want to. Others may have that choice. So ideally, though, as we go through our professional careers, our working period, we will develop a wealth, develop a portfolio of investments of some kind, and that will give us more options as we get older. And those options aren't just for retirement. They may include things like travel, being able to help our children, being able to pursue charitable endeavors. There's all kinds of reasons why building wealth may be a desirable goal to have. And again, just like all of the things we talk about on this show, each of us has to determine what is our individual definition of success, and where are we going to find the greatest happiness, the greatest satisfaction, maybe is better than happiness, in this area of our lives. So, like I said, today I'm going to talk about some investing fundamentals, and I put together a little presentation, as I often do. I'm going to go ahead and share my screen here. And and let's see, where is here we go, slideshow, play from start. Okay, so here we are, investing fundamentals. You can see our wavy green field, green for money, maybe. In the United States we have greenbacks, so whatever. As I typically do, I like to just mention the basis for the show, which is the 3 pillars of attainment. And we're dealing here in the pursuits pillar, in the finances realm. And while the focus is on finances, as I mentioned a minute ago, our finances affect many other parts of our lives. So directly, whether we can play or not, and if so, how much we can spend playing, and same with learning. But it also may affect the relationships we have with our family, our friends, even God. And of course, it will typically have a material impact on our health, our mindset, and our identity. So all of these realms affect each other, and finances is one of the most foundational. And so that's why I typically deal with that particular realm. Okay, so let's look at the 5 basic types of investments that are out there. Now, as we go through this, I am not seeking to be absolutely comprehensive. There are many types of investments, and indeed, some people may categorize some investments differently than I have. The strict categorization is not really the point here. The point is to talk about the different kinds of investments that are available and various aspects of those investments in terms of things like liquidity, how quickly they can be turned into cash, risk, and other aspects of them. and diversity, for example. And so that's the point of view that I'm going to be taking. Please do not take anything I say as a recommendation for any particular investment. It's not possible for me to do that. I don't know your individual financial situation, and so it's nothing I say is meant to be a recommendation for you as an individual. This is for your background information to understand these. If I happen to name any particular investment, it's not a recommendation for that investment. It's purely an example, and I'm going to throughout seek to use sort of generic examples, so that hopefully you won't be confused by anything or misunderstand anything that I'm saying. So the five categories we're going to talk about, are the five types, are cash equivalents, securities, commodities, real estate, and collectibles. And to a certain extent, I've listed these in terms of the most liquid, which is cash equivalents, to the least liquid, meaning the ones that take the longest and or maybe the most difficult to turn into cash. Okay, now those can vary somewhat. So there may be times when a particular security is virtually impossible to sell. So if there's a security of a company that's going through a lot of financial difficulties, for example, say I'm going to violate my own rule. So you may be reading about Bed Bath & Beyond, for example. So Bed Bath & Beyond has been struggling mightily, and they've been in discussions internally, evidently, about filing for bankruptcy. So the liquidity of their stock may not be very high right now. Those kinds of discussions could cause people to say, gosh, I don't want to buy that security. And so it may be harder to sell, and or to sell it, you may have to take a lot lower price than you'd care to. So when I talk about the level of liquidity, these are in general for these categories. Okay. But any particular investment within the category may be more or less liquid than one in another category. It would depend on the specifics of that particular investment. Okay, so let's move on. Oh, good, it worked. I hit the thing on my keyboard, and you never know if these things are going to work. Okay, so first of all, we're going to talk about cash equivalents. Now, as you might guess, a cash equivalent is something that's very similar to cash and very easy to convert into cash. Okay, so the most obvious is what's called a passbook account. And sometimes you'll hear it called a savings account. By the way, this is not a money market account. That's something different. Okay, so I'm not talking about those. I'm talking about, you go to the bank and you say, I want to open up a savings account. And they do that. Now, the reason they're called passbook accounts, that comes from a long time ago, when you would literally get a little book. It was about that big, and they would list in it the deposits that you made. And each time you went in, you'd hand them your book and the money you wanted to deposit, and the teller would note it in and I think initial it. And there you go. Now you know how much you have in your savings account. These days, the rate of return on savings accounts is still very low, notwithstanding that interest rates have increased over the last year and a half. Passbook account rates remain very, very low, in most cases under 1%. Right. So if we're working with the rule of 72, which says that you divide 72 by the rate of return you're getting on the investment, and that number that you're left with is the number of years it'll take to double your money. So it's going to take you more than 72 years to double your money if you put it in a passbook account, right? So really, these days, there's not a lot of benefits to be having a savings account. I know when I was a kid, savings account rates were often 3 to 5%. They were, so it was a reasonably good investment, especially for a kid. I got money for my bar mitzvah, And I remember going to the savings and loan. I don't remember what it's called, but I remember they gave me a bank shaped like a lantern. It was very cool. I loved that bank. And I put my coins in there and stuff. And periodically my mom or dad would take me down to the savings and loan and I put that in my savings account. Okay. So those are passbook accounts. You can get them at banks. You can get them at credit unions, have a similar type of account. And it takes virtually no time to get your money out of the account. It's not quite a demand account, which is what a checking account is. A checking account is a demand deposit account, meaning you can demand your money and it'll be given to you essentially immediately. That's not an investment. That's just a place for your money to be held so you can transact. So a passbook account wouldn't necessarily be available to you immediately, although in many cases it is, but it's going to be a very, very short time for you to get your money out of that account. Now, another type of cash equivalent investment is a CD, what's better also known as a certificate of deposit, and these are basically commercial paper. Or it's sort of like a loan that you're making to a company that issues the CDs, and they have varying lengths of what's called maturity. So you can get a 90-day CD, a 1-year CD, a 5-year CD, and the longer the term of the CD, the higher the interest rate. Okay, and the reason that you get the higher interest rate is because if you buy a 5-year CD, you have to hold it for 5 years to get your money out. Otherwise, there's a penalty if you cash in the CD early. Okay. So they're cash equivalents in the sense that they're very safe, and they're easy to turn into cash. The one thing you've got to be concerned about is matching the term of the CD to the need for the money. So let's say you're saving up for a house and you want to buy a house in 5 years. You probably don't want to buy a 10-year CD, right? Because you'll get to the 5-year point when you need the money for the down payment, and the CD has another 5 years to go before it matures. Okay, so that's the key thing about CDs. These days, CDs also don't pay a particularly high rate of interest. But if it's, if you're setting aside money that you're maybe for like a rainy day fund or something like that, and you want to kind of have a certain amount of money available to you over a certain period of time, then CDs may be, a good place to put that money. They're very safe and essentially very liquid. Okay, there you go. Now let's get into something a little more fun, shall we say, securities. Now, I'm going to talk about 4 types of securities. There are others, okay? And we could spend probably weeks talking about securities. So this is going to be just the real basics of securities. I'm checking my time here to make sure I'm not going to run over time. Okay, and the 4 types I'm going to talk about are bonds, stocks, mutual funds and EFTs, and options. Okay, so bonds, let's start there. You've probably all heard of bonds. What is it? It is, simply put, a loan. Okay, so if XYZ Corporation issues corporate bonds, when you buy those bonds, you're lending that company money. Okay, it's just the loan is done in increments based on the size of the bond. So a bond may be a corporate bond typically in denominations of $1,000. So if you buy 10 corporate bonds or $10,000 of bonds, you're lending $10,000 to that company. Okay, and then depending on what the term of the bond is, it could be, let's say it's a 10-year bond. So at the end of 10 years, you should be getting your $10,000 back plus your accrued interest. Okay, now again, it depends on the bond. The bond may pay interest as you go along, so you may get an interest payment every year, or in some cases, depending on how the bond is created, you may get all your interest at the end. Okay, And bonds are issued by companies, but they're also issued by governments. So you may have heard of T-bills, treasury notes, and treasury bonds. Okay, those are all instruments of the federal government, the US federal government. And the reason for the different categories is they describe the length of time that the bond has until maturity. So a treasury bill is basically a loan to the federal government for a year or less. Okay, now the thing about treasury bills is, let's say you buy $1,000 T-bill, you're actually not going to pay $1,000 for it. You're going to pay something less than $1,000. And then at the end of the year, you're going to get $1,000. And the difference between what you pay and the $1,000 is the return on your investment. It's essentially the interest you get for lending that money to the federal government. Okay, so some bonds like T-bills are sold at a discount, meaning for less than the face amount of the bond. Okay, and your return, the profit you make on that investment, comes from the difference between what you paid for it and what it's worth at maturity, meaning when it's ready to be paid off. Okay, now a treasury note is a mid-range investment. I believe it goes up to 10 years. I could be wrong on that, but it's a mid-term investment. So it's longer than a T-bill, but shorter than a treasury bond. And then a treasury bond is anything of a longer term than a treasury note. Okay. Now, because these are instruments of the US government, the US federal government, they are backed by the full faith and credit of the United States, which means that the government presumably raises tax money, et cetera, in order to make sure that you get paid off. So they're considered very, very safe. To the best of my knowledge, the federal government has never defaulted on any T-bill, T-note, or T-bond. Okay. And that's why you will find, generally speaking, they have a somewhat low interest. So last time I checked, for example, I think the 10-year treasury, it was a little under 4%. Okay. Now, by the way, that's much higher than it was a couple of years ago when the 10-year treasury was at, I think, about 1.5% or something like that. Okay. So because interest rates have gone up, so has the rate of interest that the government has to pay on its debt. Okay. And just like we were talking about with CDs, generally speaking, the longer the term of the bond, the higher the interest rate will be because of the lower liquidity that you have in a longer term bond. That goes for government bonds as well as corporate bonds. Okay, now there's a second type of government bond called a municipal bond. Okay, now a municipal bond is a bond issued by a state or a municipality. It could be a county, a city, in Louisiana, a parish. Okay, all of those are government issued bonds. Okay, but they are not issued by the federal government, so they're not backed by the full faith and credit in the United States. They're backed by the full faith and credit of the municipality that issues it. That's not the same thing. And there have been municipal bond issues that didn't get paid. Okay, so they are riskier than US government bonds, but generally speaking, most people would consider them safer than corporate bonds in general, right? Going back to what I mentioned a minute ago, any particular municipal bond might be riskier than another corporate bond. So if you have a corporate bond of a blue chip company and you've got a municipal bond of a municipality that's on really shaky financial grounds, so in that case, the corporate bond may actually be a safer investment than the municipal bond. It depends on the specific circumstances. Okay, so while we say in general that risk, the highest risk is corporate bonds, middle risk is municipal bonds, and lowest risk is US government bonds, that does not apply to specific issues of bonds. Okay. Now, in corporate bonds, you have what are called credit ratings. So you'll have investment grade and non-investment grade, or what's sometimes called junk bonds. And as you might imagine, investment grade bonds are considered safer than junk bonds, right? And there's several different rating services. There's Fitch's, there's and I'm going up on the other two now all of a sudden. Standard & Poor's, and there's a third one, and they will examine the financial strength of a particular company and give that bond a rating. It may be like AAA, it may be BB plus or something like that. There's a series of them, and it gives you an idea of what the relative risk is of that particular bond issue. Okay, and certain investors are not permitted, for example, to invest in junk bonds by law. Okay, now as an individual, you typically would not have those kinds of restrictions, although you might have them in certain vehicles you would put together. All of that has to be examined before you would make a decision about a bond purchase. Okay. Okay, so anyway, that is bonds. That's one type of security. The next type of security are what are called stocks, or sometimes known as equities. Okay, now again, we can get into lots of complications, but basically there's two types of stock. One is preferred stock and the other is common stock. Okay, and stock is issued by a company in order to raise capital. Okay, and they use that money for whatever purpose they're raising the capital for. It may be for expansion. It may be to the people who founded the company may have stock in it, and they want to monetize some of that investment and diversify their portfolio as a result. So there's many reasons why companies issue stock. Now, the thing about stock is when you own stock, you essentially own a piece of the company. That's why they're called equities, because you own equity in the company. Unlike a corporate bond where you're a lender to that company, as a stockholder, you're an owner of that company. Okay. Now, we talked about I mentioned the two types before, preferred stock and common stock. So preferred stock works very much like a loan, even though it's really an equity position. Okay. And so preferred stock typically comes with a rate of return attached to it. Okay. And that is the return on the stock that you get. Typically, you don't have voting rights with preferred stock. But in terms of the priority of what would happen if the company went bankrupt and who would get paid, bondholders typically will be paid ahead of preferred stockholders. Okay, because preferred stock is an equity and bonds are a debt. Okay. The more common type of stock or equities is common stock. And when people talk about stock, oftentimes that's really what they mean is they mean common stock. Okay. And in common stock, you not only do you own a piece of the company, but you have certain rights with respect to how that company operates. So once a year, the company is a publicly traded company, is required to have an annual meeting. And at that annual meeting, they will elect some or all of the members of their board of directors. Okay. And as a stockholder, you get to vote on who those people will be. All right. As well, you may get to vote on certain proposals. Okay. So you'll have what's called a proxy, which is information on what you're going to be voting on. And you'll read through it. And these days you see all kinds of different proxies. It could be on some sort of executive compensation plan. It could be on some kind of disclosures related to political contributions. It could be on some sort of behavior with respect to the environment and or other political issues. So there's lots of different things happening, and typically in a proxy, what you'll see is what the proxy, what the question is that's being voted on, or the issue is that's being voted on, and then the board of directors will give their recommendation as to how they think the shareholders should vote. You're not required to vote that way, of course. It's just their recommendation, okay? But in many cases, you will see, directors recommend voting against this because it's putting some kind of constraint on how the company can be run, and generally speaking, they don't want that constraint. Now, again, it varies. So I'm just saying, I'm making a general statement. Any particular company, that may not be the case. Now, with common stock, there are two ways that you might make money on that investment. Okay, one is the company may pay dividends. Now, dividends are kind of like interest, except that the company does not have to pay a dividend. Even a company that may have a long history of dividends can stop paying them. And there's nothing that the shareholders can do about that. Okay, so if in the news, not recently, this is going back a few weeks now, with the Disney company, Norman Peltz and his fund, what they were arguing with Disney, and one of the issues that that Peltz didn't like was that Disney had stopped paying a dividend, and Disney was known as a stock that paid dividends for literally decades. Okay. But even though it paid it for decades, that doesn't mean next year it has to pay a dividend, or next quarter. It's all depends on whether the board of directors decides to pay a dividend in any particular period. Okay, but dividends are one way to earn a return, earn a profit on an investment of common stock. The other is for the value of the stock to go up. Okay, so if the value of this, if you bought the stock at 20 and it goes up to 25, then you've made a 25% return on the price of that stock. Now, of course, it has to be adjusted if there were brokerage fees or whatever, but discounting that for right now, and because there's so many places where you can trade stocks for free these days, without, well, not for free, but without paying a brokerage commission. So if the value of that stock went, or if the price of the stock went from 20 to 25 over a 6-month period, and at the end of the 6 months you sold it for 25, you've made a $5 profit on a $20 investment in 6 months. That's equivalent to a 50% annualized return. Okay, because it only took 6 months to make the $5. So if it had continued on the same trajectory, it would have risen to $30 by the end of the year, and you would have made $10 on the $20 investment. That's why I use the term annualized. It's not an annual return, it's an annualized return, meaning you got it over a period shorter than a year. But in order to compare it with other investments, we'll oftentimes look at an annualized yield. Now, just like the common stock price can go up, it can also go down. So you can lose money, and that's part of the risk of buying common stock. Okay, so the way people make money on stocks is by, I'm sure you've heard this, right? Buying low, selling high, right? That's the deal. Now, people can try and time the market and all that kind of stuff. I'm not going to talk about investment strategies today. That's a separate discussion. But in order to really make money in stocks, while you may make some money off of dividends, typically the real money in common stocks comes from price appreciation, meaning the price of the stock goes up and you're able to sell it for more than you bought it. Okay, so that's stock. That's a second type of security. Then you've got mutual funds and exchange traded funds. So they are not the same thing. And the reason I'm grouping them together is because what they do, a mutual fund is a company, an investment company formed to buy stocks, okay, or bonds. You can have a mutual fund that owns bonds, another one that owns stocks, another one that owns both, okay? It depends on the objectives of the funds. And there are, I think, at least hundreds, if not thousands of mutual funds, okay? Now, what a mutual fund is doing is it's giving an investor the opportunity to own a diversified portfolio of securities without having to buy the individual securities themselves. Okay, so instead of buying 10 different stocks, for example, you could buy shares in a mutual fund that has 10 different stocks in it, or 20, or 30, or 50. It depends on the mutual fund. Okay, so it gives you diversification without having to buy a whole bunch of different stocks, okay? And in some cases, you may be able to buy a share of a company within the mutual fund at a much lower price point than you could if you bought a share of the company directly. So if you've got a stock that's priced at $1,000, okay, to buy, one share would cost you $1,000, but you may be able to buy $1,000 of a mutual fund, and it includes that stock in the mutual fund. Because the mutual fund's total assets are hundreds of millions of dollars, you have a teeny piece of that company, okay, but you still have that piece, okay, and that might work out well, okay. Now exchange traded funds are also basically an investment company. The difference with an exchange traded fund is these funds track different exchanges. So you might have a fund that tracks the S&P 500 or something, or the Dow Jones Industrial, what I think it's 30 stocks in the Dow Jones. Okay, so whereas with a mutual fund, you can have ones that are actively managed, or ones that they buy a portfolio of stocks and they don't buy and sell shares within the fund. With an exchange traded fund, they're only going to change the fund if the index is tracking makes a change to the index, which doesn't happen very often. Okay, but what ETFs allow you to do is invest in the market overall. So if the S&P 500 goes up over a year, well, so then the value of your investment is going to go up by the same amount because you're invested across all of those stocks. Okay, for smaller investors, oftentimes that's where they'll most likely invest, is in mutual funds, because it gives them the opportunity for diversity to diversify their investments without having to have a huge amount of money to invest. Whether it's a proper investment for you or not, don't know. Would have to know, you'd have to look at your individual circumstances, but that's oftentimes where you'll see mutual funds used. Okay, and finally, there's options. I'm actually not going to spend a lot of time on options. Essentially, an option. Oh, there's Siri. She scared me. Options basically are a contract to buy or sell a security in the future. Okay, you may have heard of things, they're called puts and calls, and depending on what you buy or sell, that determines what your obligations or rights are. Okay, and oftentimes they're used to hedge other investments. So you may have a particular investment in a particular stock, and you're afraid maybe it's going to decline, so you may buy some options so that if the stock declines, the options will help you not lose money. Okay, options are a very sophisticated security to buy. Okay, it's not for, in general, I would say it's not for kind of the average investor. You have to be very, very knowledgeable to do well in options. Okay, I have a friend who periodically likes to trade in them. He's a pretty knowledgeable guy, and he was, he last time he was doing this, telling me that even as careful as he was making mistakes. Okay, but I just wanted to include that in there because you've probably heard of them. Okay, and they are a type of investment. Okay, something that you need to learn a lot about. Now, I mean, that's true of all investments, of course, but options can be very tricky to understand. They're not as straightforward, at least from my perspective, as stocks and mutual funds and bonds. Okay, but they are another type of investment that you may consider as you work out your overall portfolio. Okay, so those are securities. Now, let's talk about the next category, which is commodities, or what's sometimes known as futures. Okay. Now, I'm going to talk about the four main categories of commodities, which are agricultural products, metals, energy, and currencies. Okay. Now, when you buy a commodity, what you're actually buying is a contract for the delivery of that commodity at some point in the future. And you're essentially betting on what that price will be, what the prices you'll get for that commodity at the point where your contract is due. Okay? And while you may not take physical custody of the commodity, probably won't, okay? You own a particular commodity, or you own it, like in agricultural goods, you're going to own it when it gets harvested, if it's some kind of plant, or if it's some kind of animal, pigs or cows or whatever. So you'll own in essence, the carcasses once they're slaughtered and ready for delivery. Okay. In the case of metals, we're talking about gold, silver, platinum, copper, tin. Okay, these are all raw materials that are used typically for manufacturing. Okay, and they're being mined and produced in many places in the world. Okay, and just like with an agricultural product, when you buy a metals commodity, you have a contract for a certain amount of that metal to be delivered at a certain price at a certain point of time in the future. That's, by the way, why they're called also futures, because you're buying them at some future point in time. Okay. By the way, I have to mention this, especially since I saw the movie again not too long ago. Back in I believe it was the 1980s, there was a movie called Trading Places. Brilliant movie with Eddie Murphy and Dan Aykroyd and Jamie Lee Curtis. And I can't think of the name of the fellow who plays the butler. But the sort of basis for the movie is these two commodities brokers have a bet about something. And what's fun about the movie is you get to see a little bit about how commodities trading works. So if you are interested in commodities, I encourage you to watch Trading Places. Watch that movie. It's a lot of fun. Eddie Murphy and Dan Aykroyd are terrific in that movie, and you'll also learn a little bit about how commodities work. You'll see. I think they actually shoot a scene on the floor of the Commodities Exchange in New York at that time, which was in the World Trade Centers, and you can just kind of get a feel for how the whole business works. So anyway, that's just a fun little side thing about commodities. Okay, as we talked about metals, energy would be things like petroleum, natural gas, coal. These are all sources for producing energy, and again, they're traded just like any other commodity. And then there are what are called commodity currencies. These are things like the New Zealand dollar, I believe it is, the South African real, the Brazilian peso, I want to say. So certain currencies trade as commodities, okay? And people oftentimes they may use them, again, in order to sort of hedge investments that they're making in other areas, okay? Commodities like options are one of the more complex types of investments to make. Okay. I had a business associate back when I had my real estate company 30 years ago. He loved trading commodities, and he would typically lose his shirt every time he did it. And candidly, I have never invested in commodities. It's just not my thing. I don't know enough about it to be effective investing in it. But it is a fairly common investment, and it is out there, and there are people who know the business or this type of investment very, very well, and they make money in it. And this may be something that you find interesting, and if so, again, dig in, learn as much as you possibly can about it before you would make any investments, and also get some advice. Is this really the right thing for you to be investing in? Commodities can be very, very risky for a whole host of reasons. Commodities generally are impacted by an international marketplace nowadays. So, oil is an international market. I was listening to someone on the radio earlier today, and he was responding to somebody saying that if you use a gas heater, you are in essence supporting the war against Ukraine because Russia produces gas. And he was saying, well, but if I'm using my gas heater in America and the gas is bought in America, so I'm not using Russian gas. That's not exactly correct, because the market for these commodities is international. And although there may be sanctions on a particular supplier like Russia, still whatever gas Russia gets out onto the market affects the worldwide market price. Okay, so to a certain extent, commodities are somewhat fungible, meaning just because you say you're only buying from this source, but that still affects the worldwide market and affects how much money another supplier will get. So they're much more complex, I think, than most of us really consider, and unless we sit down and really start working our way through what all of this means. Okay, but again, with commodities, might be appropriate for you, might not be something for you if you're interested to check out and really dig into it. Okay, next is real estate. So those of you who've seen the show before, I had a long history in the real estate business, and real estate, for many people, this is essentially all the investment. I'm not going to invest in securities or any other stuff. I want real estate because I can go there, I can see my investment. Oh, fine. That's fine. Real estate may be a good investment. It may or may not be appropriate for any particular investor. It just depends on what their financial situation is, what their investment objectives are, what kind of opportunities are available to them, and many other factors. Okay, so I've listed here 4 of the most common types of investment real estate. Okay, we're not, when we talk about real estate as an investment, not talking about your personal residence. Okay, that's not an investment, not really. That's where you live. You may make money off of owning a personal residence, but presumably the reason you bought that house was to have a place to live. Okay, and while in California, people seem to think that there's, I don't know, a God-given right that their house value is going to increase. Even here in California, that is not the case. And there are a number of markets nationwide now who have seen price declines over several months on residential housing. So, that's not really an investment in the terms of what we're talking about here. Now, that's not to say that residential properties cannot be an investment. They may be. You may buy a house for investment purposes, but you would buy it typically differently than you would buy the house to live in, especially to live in long term. Okay, so houses can be an investment that you're going to buy the house, fix it up, rent it out. okay, and get the rent from it, or you're going to fix it up, turn around and resell it at a profit. So-called house flipping, you see all those shows about it on, what is it, HG Network or whatever it is. Okay, so they can be an investment, and a lot of people start by investing in a house because it's, generally speaking, the least expensive type of real estate to buy. Okay, and then from there, oftentimes they will move to residential income, i.e., what's also known as multifamily. Could be anything from a duplex to a 1,000-unit building. Okay, to a certain extent, they work the same. Okay. Now, you have what are called residential 1 to 4, meaning a house or a condominium up to a 4-unit building or a fourplex. Those are treated differently than 5+ units. And the reason is because of how the government supports the financing of buying those types of properties. So residential 1 to 4 has a particular type of financing available that is not available for 5 units and above. Okay, and generally speaking, the interest rates on loans for 1 to 4 units are lower than interest rates available for 5 and above. And also, the percentage of money you can borrow on residential 1 to 4 is higher than on 5 and above. Okay, so there is that break there. But in the end, residential income, look, you're buying a place where people can live. They pay rent. Generally speaking, they're paying a gross rent, meaning they write you a check and you're paying for maintenance, oftentimes for at least a part of utilities. You're paying the property taxes, you're paying the insurance, okay? And all of that comes out of your rental income. And then if you've borrowed money, which typically people do, so then you're going to pay your loan payments, and whatever you've got left, that's your cash flow. And that's the return on the cash portion of what you invested. Okay. So, like I said, many people start their real estate investing with residential. Okay. But there are other types of properties to invest in. There is commercial. Now, commercial has several property types within it. So you could have retail, which could be anything from a little strip commercial center to a shopping mall and other things in between. Okay. You can have office. Okay. Office buildings. And again, there's lots of types of office buildings. So you can have just your typical little, small 10,000 square foot, maybe it's a single user office building, or even 5,000 square foot. You could have a high rise office building like, the Empire State Building, right? It's a huge office building, but it's for general office use. There's medical office buildings. There are office building campuses that are almost a hybrid between office and industrial. Okay, so there's many different types of office buildings, and as you might imagine, coming out of COVID, office buildings are one of the areas that has struggled the most. You'll also hear different quality of office buildings. So you'll hear Class A, Class B, Class C. So Class A, as it sounds like, is the highest quality office building, okay? Class B is kind of a mid quality, and Class C is low quality. And these days, it's the new Class A office buildings with very high amenities still in general seems to be doing pretty well. Okay, but when you start getting down into Class B and Class C, a lot of those properties are struggling. In some cases, they may have obsolescence issues, meaning they're outdated for what tenants want these days. Okay, so with office buildings, it's not monolithic, just like it is not monolithic within retail centers. Okay, so office, retail, commercial, those are some of the categories under this overall umbrella of commercial real estate. Okay, then you have industrial real estate, and again, there's lots of different types. There's hardcore manufacturing, where like where you're manufacturing these like automobiles. Okay, then there's light manufacturing, where maybe you're manufacturing toys or something like that. okay, or where there's high-tech manufacturing, okay. Then there's also cold storage where food products that need to be kept cold, meat, seafood are kept. Then there's just regular warehouse, like, what a company like Amazon might hold, okay. And then there are different R&D type industrial buildings, okay, where they may have clean rooms. By the way, they could have clean rooms in a manufacturing facility as well, okay. So there's lots of different types of industrial properties as well, okay. And overall industrial properties have been doing pretty well, coming especially during the pandemic, because so much of shopping shifted online. And so companies like Amazon and Walmart, they were fulfilling orders out of their warehouses instead of their stores. Well, Amazon has very few stores, but in any event, more and more warehouse was being used. They become larger, taller, with computerized cranes and all that kind of stuff. The days of when you could only build a warehouse as high as a forklift could lift something up are gone, because you can have computerized cranes that you can have an operator sit at a terminal and just punching things, and the crane goes and pulls the thing off the shelf and brings it down to the loading dock, and bang, there you go. So they're very, very sophisticated these days. Quite interesting. I used to, when I was in the real estate business before, I did a lot of work in industrial real estate. It was one of the most enjoyable things that I did, because it was so varied, and you were oftentimes seeing things being built. So now, by the way, industrial also would include things like lumber mills, mineral processing facilities. So that's industrial type real estate as well. Those can be difficult to deal with. You may have issues of contamination and those kind of things that have to be worked out, but all of that falls under the rubric of industrial real estate. Okay, and then finally, the other type I'm going to mention is hospitality. This is hotels, motels, resorts. So it's places where people go for entertainment and relaxation. Entertainment centers may not necessarily fall within hospitality. That may be more of a commercial retail use. These days, some of the categories are not as distinct as they used to be, but hospitality is also a big area in real estate investing. And it took a big hit, of course, during COVID. It's come back pretty strong more recently. Okay, and then there are other types of real estate. So these are the four that I just chose to talk about today. There are other types. There's special use properties, casinos, for example. I used to work on casinos. Trying to think of something else, some kind of weird thing. Oh, port facilities, that's a special use property. So there's other types of real estate that's, that people invest in. Land, of course, farmland, timberland has become a big real estate investment type recently for environmental reasons. So there are other types out there besides what I've listed here. And again, just like with all the other types of investments, it's going to depend on what your objectives are, what your financial situation is, whether real estate is the right investment for you or not. And by the way, there's different ways of investing in real estate. You can invest directly by owning the property yourself. You can invest as a partner. You can invest in something called a REIT, which is actually a security that a REIT is a company that owns real estate and then sells securities based on its portfolio, basically. So there's lots of different ways to add real estate to your investment portfolio, depending on what's appropriate for you. And all of that should be taken into account before you would make any decision about investing in real estate. So we got to look at my time here. Yeah, we're coming up on time here, so I want to get to the last one real quickly. I'm not going to talk about this a lot, but I did want to mention it because there are some interesting things happening in collectibles, or so-called hard assets. So art, coins and stamps, wine, especially investment grade wine, memorabilia, sports memorabilia, comic books, all that kind of stuff. So they can be good investments. Okay. Now, I wanted to talk specifically about art, because typically art was something only the very wealthy could afford to invest in. Like I'm trying to remember what I don't remember what artist it was. I want to say Chagall maybe recently, or they're anticipating that a couple of Chagalls are going to sell for $80 million, $100 million. I could be off, but I mean, huge number. Like you and I we're not going to go buy a Chagall. Okay. Recently, there have been some apps that have come out where at a much lower price point, people can invest in art, and they'll have access to those kind of investments on essentially a shared basis that they wouldn't have before. So there is some of that going on these days that may make this asset class available to a larger group of investors than historically was the case. So as technology develops and grows and changes, so will the opportunity for investments. Okay. And one of the areas where that's having an impact is in collectibles. Okay. The other thing about collectibles is they're fun, right? I mean, I have a collection of wine, although it's not really, this is not, I don't have investment grade wine, but I have a collection of wine. I have a collection of coins and stamps and memorabilia. I mean, the main books as well. The main reason I have them is because I enjoy them. I like looking at them or reading the books or drinking the wine, whatever. But, you know, oftentimes that's where people start, and then they get more serious and they get much more investment oriented in these collectibles. Okay. So, if there's something you have a passion about, maybe that's an area for you to investigate as a potential investment. Okay. Gosh, we're coming right down to the wire here. So those are the five main types of investments. Now, of course, there are other types of investments I didn't even mention today. And you know, there are all kinds of hybrids, like I was talking about, real estate investment trusts. You know, things are getting more and more sophisticated, more and more complicated. Investment promoters are always looking for new ways to package investments that can make them more accessible to a larger number of people, can make them more sophisticated, can make them safer. All of these things are happening. And so this is why before you make any investment, you want to be educated, you want to get professional advice, and you want to make sure that whatever it is you're investing in is appropriate for your situation. Okay, and as always, if you have questions, comments, whatever, here's I'm showing up here on the screen. Here's my contact information, and it'll be in the show notes as well. If you have any thoughts you want to share with me, if you want to take issue with anything I said, feel free. I will do my best to respond quickly. But I think it's good to know the fundamentals of investing, so that as we make money, we can build wealth as well. And here's all the legal stuff. Just want to show this real quickly. Bang, that's the end of that. And then that's over. And here, let's stop the sharing. We'll go back into the room. Here we are. And we're coming up on our hour together being done. So I want to thank you for joining me. And we will talk more about investing. We'll talk more about wealth building. We'll talk more about how to build our professions, how to build a business in the coming weeks. I have some great guests coming up. So please plan to join us every Wednesday at 12:30 p.m. Pacific time, 3:30 p.m. Eastern time. And also, I have a second show now on Tuesdays, 10:30 a.m. Pacific time, 1:30 p.m. Eastern time. That show is Business Lessons from the Military. So what I'm doing is going through different sources of military doctrine, great leaders, military history, and distilling from that knowledge and wisdom that we can use to help run our businesses better and be more successful. So I invite you to join me. Boy, Siri she's just really active today. I invite you to join me on Tuesdays for a half an hour. It's a shorter show. Okay. And you can join me live. Keep an eye out for the emails, or go on Eventbrite and find the Way to Wow show on Eventbrite. You can always get a free ticket there if you want to join me live in this room and ask questions, or you can watch on social media, on YouTube, on Facebook, Twitter, and LinkedIn, all of our various social media channels. So thank you very much for joining me today. I hope you found this useful, and it'll inspire you to look at building wealth as you pursue your progress in the finance realm of the pursuits pillar of attainment. And that just leaves me to acknowledge, as I always do in signing off, my dear friend up in heaven, Marie, darling, you are still my bell, and I hope I'm still your bow. Thank you again for joining me, and we'll see you next week.